Okay, here we go. Welcome officially, everyone here live, as well as everyone who is watching on the replay. This is the Crypto Cash Flow Workshop. So, we're going to be digging into some strategies, we're going to be digging into some tactics, and we are going to be digging into some specific tools that are available online for everyone right now that allow you, me, anyone who wants to be a crypto investor. These tools allow anyone who wants to be a crypto investor to take their idle crypto assets, Bitcoin, Ethereum, Solana, XRP, whatever it might be, Pepe the Frog, if that's your jam, to take those crypto assets and rather than just keeping them as an unproductive asset, these techniques allow you to turn your crypto assets into productive assets, meaning, big picture here, conceptually, having a productive asset simply means that those assets that you hold also produce something else. Okay, so an example of an unproductive asset would be gold. It can go up in value, it can go down in value, but if you buy a kilogram of gold in 30 years, you still have, hopefully, a kilogram of gold. It just sits there, it doesn't really do anything. Examples of productive assets, easiest example would be real estate, right? You buy the asset, the property, and you can hold it. That thing can go up or down in value depending on what the market is doing. But then it's productive in the sense that it produces a cash flow in the form of a rental fee income. Someone comes in, they want to lease it out from you, they pay you money to utilize your assets. So we're going to be talking about applying that principle, which isn't a new principle, it's been around forever, as long as financial markets have existed. We're going to apply that principle to the world of cryptocurrency or decentralized finance. Okay, sort of the colloquial term is just crypto, but it includes a much broader scope of the world of decentralized finance and blockchain technology and new innovations that are currently being built to establish the new infrastructure of what this new financial market is becoming. So let me share my screen and we will dig right in. All right, so you should be seeing a big whiteboard, which simply put just says principles, strategies, tactics, tools. Today, we are going to be focusing primarily on these three. Now, I always bring this up at the beginning, and it never fails that someone inevitably only wants to talk about these two down here. And that's the sexy stuff. And that's where most people want to start. But we're actually going to lay the foundation first with a quick overview of the actual strategy that will be served by the tactics and the tools. Okay. So the folks who are asking, well, which crypto should I buy? Well, that's focusing on a tactic, right? You're starting down at the lower level because you're just thinking, oh, I should buy the thing and wait, right? And then something will happen and I make some money and that's great. But it's akin to asking, I used to be a personal trainer years and years ago. It's akin to asking, well, what's the best workout? Well, the answer is it depends on a lot of different variables. It depends on your goals. It depends on past injuries. It depends on your physical capabilities at the stage in life. Any number of different variables will come into play. So it's not about what's the best crypto to buy, what's the best workout. Those things, those questions come into play, but we want to start here with a strategy, and then that strategy will inform which tactics we employ, and the tactics we employ will then let us know which tools that we are going to need in order to get the job done. Now, on this session, I am going to give you the tactical tutorial using a tool called Orca in the Phantom Wallet. We are going to do that, just so you know, it is coming. But I want you to understand why I click the buttons that I click when I get to that point of the session. Okay. So, what is this strategy that I keep alluding to? It's very straightforward when you look at it conceptually. So, the first piece here is saying, hey, I have some crypto assets. I want to take those two crypto assets, whatever they might be, and I want to mash them together to create what's called a liquidity pair. So this will be my LP, my liquidity pair. And just for the sake of talking about this and the demo, I'm just gonna, well, hold on, because I'm gonna do the demo with Sol. So I'll say Solana and USDC, right? So I've got Solana. And sorry, real quick, I'm just going to mute everybody because it sounds like we got another person with a background noise here. Do-do-do-do. Cool. I think I got everybody muted. If you're not muted, go ahead and mute yourself. That'll be very helpful. Okay. So I'm going to take my crypto assets. I've got Solana and I've got USDC, which is a stable coin. And I know ahead of time that many people like to trade Solana for USDC, USDC for Solana. Those are the bots and the day traders, the retail investors, the people who don't know any better. And they're just going, oh, buy low, sell high, buy low, sell high. They're staring at charts 3, 4, 5 hours a day. They're trying to make a quick profit by like playing that buy, sell, buy, sell, buy, sell game. But that's actually good for us when we are the liquidity providers because we know that when people create that trade, Solana for USDC or the other way around, that creates what's called trade volume. And I'm going to show you later just how significant the trade volume is because there are literally hundreds and hundreds of billions of dollars in daily trade volume going through all different various decentralized exchanges in the crypto market, like right now. And the crypto market, as we know, is open 24/7. So trades can happen all over the world, all day, every day, and you don't have to do anything about it. You just sit back and watch the show. So we've got our LP, our liquidity pair, which is Solana and USDC. Now, when someone wants to go trade, they're going to transact with what's called a liquidity pool. So this is the pool, and Mr. Trader over here comes along and says, hey, I want to put in some Solana and I want to pull out some USDC. And another trader comes along and he says, well, I want to put in USDC and I want to take out Solana. So inside this pool, this liquidity pool, and there are thousands of these all over the internet. There's lots of Sol, lots of Sol, lots of Sol, and there's lots of USDC, lots of USDC, lots of USDC. And what happens is when this trader wants to make that transaction, he's going to pay a very small transaction fee. And the fees range in terms of the percentage of the value of the transaction, but they can add up significantly over time. And again, I'm going to show you an example of this later, and you'll see, oh my word, every day this pool is generating 70,000 in trading fees. This pool is generating 300,000 in trading fees, whatever the number might be. The point is that every single day there's these huge sums that are being generated just from the transaction fees regardless of short-term price action. And that's a critical point because most people think only in terms of price action. They go, oh, I bought Solana for 120. Now it's 160. I'm going to sell it. I'm going to make money and I win. And you're right, that is a win. But back to our real estate metaphor, if I buy the house for 1 million and I sell it for 1,200,000, that's a win, right? I made 200 grand. Hey, great. But if I buy the house for 1 million and also collect rental fees and then sell it for 1.2 or 1.5 down the road, now I have also captured the market upside, but along the way, I've added another layer of profit opportunity. So that's the main premise here is that we're talking about adding multiple layers of profit opportunity to the mix so you don't have to rely on only one profit opportunity. Because let's say the market just goes sideways for a year. Oh, I bought Sol at 150. A year later, it's still at 150. But in the in between times, it went up and it went down and it went up and it all over the place. Well, if I had been a liquidity provider during that 12-month period, I could have collected anywhere from 70% to, in Solana's case, probably closer to 100% APR. Meaning if I started with 50 grand, I'd have another 50 grand on top of that because I chose to participate as a liquidity provider. So back to our little model here. We're creating all these transaction fees, millions, billions of trades happening online every single day. And here's you hanging out, and you're going to be a liquidity provider. So you put in a certain amount of SOL USDC, the pair. You got to put both in there. You put those in there, and then you are going to get paid a portion of the trading fees in conjunction with what percentage of the total liquidity you are providing. Here's what that means. If this pool in total has $1 million in it, and if you are providing 10,000, just to make the math easy here, you are providing 1% of the total liquidity in that pool. And so if this pool produces, let's say they produce $70,000 of trading fees in a day, well, you're going to get 1% of that. So you are going to get 700 bucks of that 70,000. Now, what inevitably happens with these numbers, and again, you'll see how this all plays out later. What happens with these numbers is people go, "Oh, Brandon, I'm only making $60. I'm only making $20. I'm only making this. I'm only making that." But you have to remember this, number one, this is all about percentages, but also it it accumulates every single day. So no matter what number you're talking about, you got to go, oh, hold on a second. I need to multiply that by 365 to get a reasonable estimate, a reasonable expectation for what my total trading fee intake will be after that 1 year. And nobody believes me at first, but hear me out. This is the hardest part, is just sitting back and waiting after you set it up. After you've set it up, the hardest part is sitting back and just being patient. Hence the name, Patient Investor, because that's the secret sauce that makes it work. And that is the number one thing that humans, myself included, the number one thing that humans struggle with is just, hey, I did the thing. Now let me just sit back and enjoy all the cool stuff that's coming my way by virtue of the fact that I'm just sitting here being patient. Okay, so that's the quick breakdown, if you will, of how a liquidity pool functions. Back to our strategy. Trade volume. Here is my number one. I'm going to create this liquidity pool. Number two, when I am a liquidity provider, I now am going to get a reward or a yield, which that's the trading fees. Okay. There are multiple different pathways and types of reward that you can earn in the world of decentralized finance. For the sake of simplicity and the strategic overview today, I'm only going to be talking about the trading fees that you're earning. There are other things that go along with that, but we're going to earn trading fees. Now, the trading fees will be paid out to you in the form of whatever asset that you are providing liquidity for. So if I am providing SOL and USDC, I am going to get paid SOL and USDC. So you can see where this starts to get really good if you're farming with assets that you believe in long term. Okay, the easiest example here, Bitcoin and Ethereum. These are two of the largest, by market cap, two of the largest projects in crypto right now. And they're an easy choice, right? Because you go, oh, I'm just going to buy Bitcoin and sit on it for 20 years. Yeah, that's a good choice. Like you're probably going to make a lot of money if you do that. Or I'm just going to buy some Ethereum and sit on it for 20 years. Great, do that. But if you're planning on holding Bitcoin and Ethereum anyway, guess what? Those are two assets that you can pair together. It'll be wrapped Bitcoin because it's on a different network, but it's still, it still follows the same price action as Bitcoin on the Bitcoin network. So you pair up Bitcoin and Ethereum and you go, hey, I'm just going to sit back with my pair. It's going to do its work for 10, 15, 20 years, whatever the case may be. I'm now going to capture the market upside, the long-term asset appreciation of those two assets. And I'm also going to add the layer of profit opportunity that is the trading fees that I'm generating. Okay. So let's say my trading fees here, I'm getting SOL and USDC. Now, step three is I'm going to take those assets and tuck them away either in a separate wallet. So here's my little separate wallet here. I'm going to tuck them away and I'm going to hold those unpaired. Okay. So this is what we call hedging. So step three is the hedge. Because if I have some base capital over here paired up working for me, and I also have another wallet that holds assets unpaired in case I want to sell a little bit along the way and take some profits as I go. Great. Now I have both options available to me. So that's all this is saying. Hedging just means I'm going to position myself in such a way that regardless of what happens in the short term price action, regardless of what happens, I am going to profit no matter what. That's all it means. Okay. And this is the hardest part for people to wrap their heads around because they're going, but Brandon, if I bought the asset at 150 and it drops to 130, I'm losing. No, you're not. Not unless you sell it all and run away, then yeah, you would have bought high, sold low, you would lose a little bit. Okay. But the premise here is you ride the wave. Market goes up, I'm winning. Well, no, you're winning because you got trading fees. Market goes down, I'm losing. No, no, you're still winning because you're getting paid by trade volume rather than only relying on chart go up. So now, chart go up, chart go down, chart go sideways, you are winning no matter what. That's why this is a hedged play, because you're able to profit and make progress forward no matter what happens in the short term. Oh, we got the doggos. They're here learning too. Kathy, I'm just going to put you on mute so the dog can bark all he wants. Okay, so step three is hedging, and that's my SOL, that's my USDC. And if I want, then I can take a portion of these and I can swap them for something else. That something else could be your long-term macro belief. So you go, I believe in Bitcoin, I believe in Solana, I believe in Guard, I believe in fill in the blank, whatever it is. But you go, I believe in this asset long term. So I'm going to swap for more of that, even though I'm farming this one over here. Or you just keep it all as SOL and USDC, or maybe you just swap it all back for SOL. The point is you have options at this point. And you can even, some people like to do this. I never recommend this. I don't play this anymore. I used to, but some people like to buy the meme coins with a little bit of that yield, the trading fees. They say, well, last week I made 800 bucks, so I'm going to take 100 of that and I'm going to go buy Mudang the Hippo coin or something like that. If that's your jam, go for it. You just have to acknowledge ahead of time that's gambling, it's not investing, but I fully acknowledge like that's part of crypto. People get excited for it. It's entertainment. Go for it if that's your jam. But the longer term, smarter, more strategic play is to say, I'm going to keep some of this unpaired, and then I'm also going to take a portion of it and feed it right back into my original pool. So compounding, right? We all know, oh, the magic of compounding. Well, yes, and the cool thing about this strategy is there's multiple pathways to compounding. One of the pathways, which is the most straightforward, is to say, I'm just going to take what I earn and add it back to my pool. That's the farming metaphor. I have 100 acres. I grow potatoes. I sell the potatoes. I cash out and buy a TV. No, no, no. I cash out and I buy more land. Now I have 105 acres. Now I'm going to grow more potatoes, assuming nothing else goes wrong with the weather and such. And then I'm going to sell those potatoes. Then I'm going to buy 7 more acres. Then I'm going to farm that. Then I'm going to sell the potatoes, buy 9 more acres. So you see how that the compounding principle, like that's why they call this yield farming, because you take the metaphor of an actual real farm that produces crops. It's the same premise. You're producing a crop, except in this context, the crop is more of the digital asset that you are farming, Solana USDC in this example. So that's one pathway for compounding. The other pathway is what I was just talking about, where let's say you go, hey, I'm farming SOL in USDC. I'm just going to sell all the USDC I earn and I'm going to buy more SOL. And so now I've just got a ton of Solana sitting in this other wallet. And then you leave it there and you wait. Because eventually, again, assuming you're participating with assets that you believe are going to appreciate long term, the likelihood that that could also appreciate and go up is very, very high. So this would be like if I grew potatoes on my farm and the day I grow them and harvest them, they're only worth $3 a bushel, but I'm going to wait a while until they go up to $7 a bushel and then I'm going to sell them. So the premise is that the thing that you yielded is also in and of itself a variable asset. So then you can also experience another layer of profit opportunity there. That's one way to do it. Or trade it all for stablecoin and just play it safe. That's another way to do it. You're still winning. You're just saying, I'd rather have almost no risk and just take my yield from the trading fees. So the big question then becomes, well, how much, Brandon? How much? What can I expect? And this is where we talk about reasonable expectations based on averages over time amongst over 300 people in the mastermind. Okay, so this is where I'm getting this data as well as my personal portfolios. The coaches and I, we talk to each other, so they've got some data as well. So we say it's not a guarantee. Obviously, it's a financial market. No one can guarantee you anything. That includes the stock market. That includes anything. No one can ever guarantee you a return. And if you start to think in terms of expected guarantee, you will inevitably get disappointed. Let me let this person in. There we go. Okay. So no guarantees, but like we said, reasonable expectations. The reason I love expectations, the reason I love that phrase is because it puts it in perspective. I'm not going to give you an exact number, but I will tell you that on average, the range that we see for our personal portfolios for the over 300 members in the mastermind, they range from 50 to 100% APR. What does that mean? That's an annualized return accounting for all the different fluctuations because you get paid based on trade volume. Trade volume fluctuates every day. It's not going to be a linear line. So you're not going to get exactly 0.27% every day, but you can average a 0.27% every day, which is the equivalent of 100% APR. Some days will be higher, some days will be lower. That's just the way the market goes. Sometimes people are trading more, sometimes people aren't trading as much. So the 50 to 100% per year on average, that is just trading fees only. Meaning, when we talk about reasonable expectations, I always personally, I like to estimate conservatively. I like to estimate on the low end. So I'm saying, hey, even if all I ever got was 50% per year on average, I'm already obliterating every other asset class that's out there. And you go, oh, but Brandon, it's crypto. I can get 20x in 1 year. Okay, yeah, you can maybe get 20x one time on a $200 bet, and then you're gonna lose it all because you keep trying to bet more and more on the same kind of stuff. Does that kind of stuff happen? It does happen, but I wouldn't rely on it. Rather rely on the tried and true slow and steady incrementally gains over time. So the 50%, I would say, gosh, even if all I got was 50% per year on average, that would be crazy awesome. Now, if I get surprised and I get 100%, even better. And again, it's trading fees only. we're not accounting for, in these estimates, we're not accounting for long-term growth and appreciation of the base assets that you are using to contribute towards liquidity pools, because we don't know how much they will grow and appreciate over time. You could say, well, in a bull run market cycle, which can last for a while, what have we seen in the past? We've seen even some of the top tier, top 20 by market cap projects. We've seen them go 2x, we've seen them go 6x, sometimes 8 or 10x over the course of an entire market cycle. But again, it depends on which assets you're choosing, and it depends on how willing you are to hold those long term and just farm with them, and then later down the road, cash out. It's like your real estate metaphor, right? You're not going to buy a house and sell it every year. You're going to buy the house once and then collect rental fees for fill in the blank, 8 years, 10 years, 15 years, and then sell it at the end. So that's why when we talk about yearly returns, we want to only estimate by the trading fees only, because then the probability that you'll get pleasantly surprised and be way happier is so much higher than if you anticipated, oh, I'm going to get 10x this year. And then you get disappointed because you only got 6x, and you start making irrational choices because you're like, it's not working the way I thought it was. Rather, count on the tried and true consistency, and then, yeah, somewhere along the way, it is very probable that you'll get pleasantly surprised by the long-term growth and appreciation of those base assets that you're using in order to be a liquidity provider. So let's just take a look at what that actually means. And I'm going to do an illustration. Again, this is not a guarantee, obviously. This is just an illustration. We're saying if you were to average 75% per year on average, meaning, hey, maybe one year it was more, maybe one year it was a little bit less. Fluctuations, right? This is normal. This is not a linear every day, every month, every year is the same thing. And I'll often get asked, well, Brandon, what are the monthly returns? And anyone who asks me that, I get it. Like you're curious what the monthly returns are going to be, but I already know where their mindset is at. I know that they're only on a short-term time horizon, even though they'll tell me, no, 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 I'm going to be in the market for 10 years. Great. Then don't worry about monthly returns. Worry about average annual returns. Because if all you're thinking is monthly, this is how those Forex trading bots advertise themselves, right? Oh my God, Forex trading bots, you're going to get 22.5% every month. And look at our track record. And you jump in and you get 22% the first month. And then the rest of the year, you either break even or lose everything that you gained in that first month. I've heard that exact story literally hundreds of times from mastermind applicants who tried algorithmic trading bots, Forex trading bots, or they got stuck in a WhatsApp group, which, by the way, they're all scams, 100% of them, I promise you. And they thought, I'm going to get 30% a month. This is going to be so great. And I'm just telling you, sorry to burst everyone's bubble, but those things never work because they're not realistic. Like it's you're never going to get an exact monthly return every single month with consistency. That's not how markets work, especially in crypto, where volatility is all over the place. But if you position yourself so that volatility is your friend and you profit from it, then when you see the chart go haywire, you train your brain to go, oh, that means money for me. Wow, now I'm happy that the market's going crazy. Versus a lot of people get scared and fearful when the market's going up and down and up and down. They go, oh, crypto's having a bad month. Crypto's having a good month. You're using words like good, bad, collapsing, whatever. But that's all fear-based. Instead, we're saying the market will fluctuate, period. Fluctuate is a very like neutral descriptor. Chart go up, chart go down, chart go sideways. That's fluctuations. Fluctuations happen because of trade volume. When you adopt this method, trade volume is your friend because you profit from it. Okay, so let's say we got 75% per year on average. I'm literally just splitting the 50 to 100% down the middle for the sake of illustration. I've got my calculator out here. And let's say I'm just going to pick a number, okay? 20,000. Now, You might start with 5,000. I don't know. But I've had people jump in and start with multiple six, sometimes seven figures with this method. So I'm just picking a random number just so you can see the potential for growth. Because it's not about what you start with, it's about how long are you willing to be patient, stay in the market at insane returns, and then walk out on the other side with an incredible return long term. Okay. So let's say I got 20,000 and I say, you know what? I'm going to be in this for 12 years. Okay. Roughly a 4-ish year market cycle. I want to ride the wave for 3 market cycles. Okay. So I'm going to stay for 12 years and I'm going to give you the outcome if you only compound once a year, meaning one compounding annually. Now, in practice, some of you will compound daily, some of you weekly, some of you monthly, some of you quarterly. But again, in the interest of the most conservative estimate as possible, I'm going to say let's just compound once per year. Okay, so I'm going to say 20,000 times 1.75 because that's a 75% return. 1.75 to the 12th power. Okay, so times 1.75 times 1.75 times 1.75, 12 times. That equals, oh, 12. That equal, and see, this is just ludicrous. That equals 16,500,000, 500,000 and 100. It's even hard to say. So again, you might look at that and go, yeah, sign me up. That sounds really good. The point is not that exact number. The point is to say, if you're willing to wait and you got this average, that's what the return would be. And you might say, Brandon, I don't need $16 million. Great. Make this 8 years instead of 12. Punch the numbers in your calculator, see what you get. This is just an illustration. The actual return is based partially on where your starting point is and where you want to get to. That's like step one is go, gosh, I'm starting with 50,000. And if I had 2 million, like I'd be like you might think this, if I had 2 million, I think I'd be set. That's really all I need. You go, great. So how many, you reverse engineer it and go, how many years will it take me to get to that 2 million? And you figure it out and you go, oh, it's only gonna take me X years if I achieve this percentage return. Well, how can you achieve such an amazing return? That's what this is. That's the strategy, right? That's the one, two, three. That's the become a liquidity provider, harvest those trading fees, hedge against all possible variables, and then compound and or reallocate. Like that's the process. And I know it sounds really simple when I say it like that, but that's because it is simple. Simple, not easy, right? There's always like buttons to click and things to do to make this happen. But when I show you the demo is setting this up. Okay, so I'm going to show you how to take the first step because that's all we can take today. Because trading fees, we would have to wait for those to accumulate for probably a couple of weeks before we could harvest them. But the point is, you can take that first step and get all of this rolling if you have the infrastructure set up. Like you've got a wallet, you've got an account, you know how to set up security, you've got your cold wallet layered on top of it for added security, all that stuff. If you've got that already, great, you can take this first step. If you don't have that already, that's okay. Like that's why we're here is to help. Okay, so we've got the strategy. We know what we're doing. We have reasonable expectations for what these returns can be. And we have more or less an idea of where this could take me long term. Okay. Because it's not about, oh, what's my monthly return? Okay, 20%. Oh, I'm only going to make a couple $1,000. No, it's not that. It's about if you learn a skill set from a coach, from a mentor who's done this before, if you learn that skill set, you can use that skill set for the rest of your life, for 12 years, for 8 years, for 25 and a half years, whatever it is. You can continue to use that skill set for as long as you want to. So it's not about the monthly return. It's not even about, hey, where's my money going to be a year from now? Because you could go, oh, 20,000, I'll double it. I'll get 40,000. Yeah. It's not even about that. It's about what's the big picture perspective if I have an appropriate time horizon in my mind that I'm willing to stick to. And you guys, I'm sure you've seen some of the posts I make on social media and some of our follow-up emails that talk about some of this stuff and talk about having the appropriate timeline, which is really, again, that's the secret sauce. That's what actually makes this work. And not only a long-term time horizon, but how much maintenance does it actually take to do this? And yeah, there's a learning curve. Like you got to put a few hours in, spend time with a mentor, learn the system. But once you get things cooking, and this is not an exaggeration, roughly 10 to 15 minutes per week. Okay. You'll hear people talk about passive income and not passive. Nothing's actually passive. Okay. I've heard people call real estate passive income. Like there is nothing less passive than real estate. Anybody who's been in it knows like, oh man, I got my tenants and zoning boards and I got to replace the pipes. Like there's just so much that goes into that. But this is what we call low maintenance. And that's critical because you go, gosh, 12 years to get that reward at the end. But I don't want to work, 4 hours a day staring at screens and charts to get there. I can't even imagine doing that. Like, that's okay. Low maintenance means a little bit of time each week. You log in, enter your password, harvest, compound reallocate. Oh, I'm done for the week. Thanks, everybody. And then you walk away and you just let it do its magic because the whole system is governed by smart contracts and smart contracts in real time, 24/7, process every single transaction as well as calculate how much of the trading fees are going to you. So it's all monitored by the third party validator, which is a smart contract, which in effect is a line of code. And that manages the whole system for you. Okay, let's dig into the demo. And let me just take a quick look at the chat here. I think someone William, in your Sol USDC example, if you hit the high limit of your LP range and you exit, do you get all the USDC back? And if you hit the low limit and you exit, do you get all the Sol back? Yes, William, I think what you're saying is if you go out of range on the top side or out of range on the bottom side, you do still get all of the assets back. And you're right to say that if you go out of range on one side, it converts automatically to one or the other. Out of range on the low side converts automatically to one or the other. And when you remove liquidity, that's what you mean by exit, remove liquidity from the pool, you still get all of those assets back. So it's not as if, oh, I went out of range, I lost everything. No, no, no. Out of range just means you're no longer going to be collecting trading fees until you either remove liquidity and enter a new pool or rebalance that position in order to start collecting fees again. Out of range is not a scary thing at all. It's just a condition of this whole process. And again, that's something we go over in detail in the mastermind. It's more about, hey, what do I do when I fall out of range rather than, oh no, I hope I never fall out of range. You'll fall out of range. It happens. Oh well, you rebalance, you move forward. All right, let me move this out of the way and I will pull up a couple of things here. First of all, this is a website called coinmarketcap.com. If you've been invested in the crypto market for any amount of time, it is highly likely that you have either looked at this and or simply heard about it. It is just a data aggregation site. It takes a ton of data from all over the internet and decentralized finance, and it consolidates it into one source so that you can view data, liquidity pools, trade volume, chart action, all that kind of stuff, okay? And the only reason I wanted to bring it up here on this session is to highlight the transaction volume. We're looking at, let's go with Bitcoin, okay? Back up to 95.5, looking good. Market cap, almost 2 trillion. Daily volume, Now, this is across multiple pools, okay? Because with Bitcoin, with Ethereum, with BNB, with Solana, there's not just like one pool, centralized pool, right? There's decentralized pools all over the place. But they're saying right now, 24 hours, $53 billion. That's one day, okay? Ethereum, market cap, just under 400 billion. Trade volume, almost $28 billion in transaction volume. Just one day. Multiply that by 365, see what you get. Okay. So that's what I mean. These numbers are just crazy. And the idea is to look at this and go, man, what are some of these assets that are being traded so heavily that I can participate them? I'm going to show you Solana, $80 billion market cap, rock solid. The trade volume, and I happen because I follow Solana pretty closely, it's actually down right now. And you're going to see it's going to quote us something like 63% APR. I've seen the APR for Solana as high as 120, 130. In a few weeks during heavy trading, I've seen it 300, 400%. Now, the 300, 400%, that doesn't last. It's just acknowledging that some weeks trade volume goes crazy and you're basically getting like a month's worth of APR trading fees distributed in a much shorter time frame. But right now we're looking at $4.6 billion in trade volume every single day just for Solana across multiple different decentralized exchange platforms and multiple different liquidity pools. Now I'm going to take you to a site called Orca, and Orca is what is known as a liquidity management platform. There are many of these online. These are useful tools that allow you to open up liquidity positions without having to go directly to the DEX, the decentralized exchange platform. So instead of going directly to Radium or directly to Uniswap or directly to PancakeSwap, I can use the liquidity management platform and it's going to help me not only open the position, but it's going to organize a lot of the data for me so that I can just view things neat and tidy. Now, remember, we said how many billions of dollars every single day for, what did it say, $4.6 billion. But look at this pool. This is, again, this is just one of those pools. This one pool alone, 172 million. And that's 24 hours. So one day's worth of trade volume, 172 million worth of transactions. TVL, total value locked, that just means the amount of liquidity that is in that pool, 41 million. So just one pool has 41 million in it. That's why it's producing nearly $70,000 per day in trading fees. That's just from this trade volume. Oops. That's just from 172 million in trade volume. Imagine 4.6 billion in trade volume, how much trading fees would be generated from that kind of volume. So the idea here is the opportunity is so vast, and all you have to do is say, well, I just want my little percentage of the pie. I don't need all of it. I just want my little cut. And if I take my little cut, right now they're saying, well, you're going to get around 60% APR. Now, that doesn't stay stagnant. It goes up, it goes down, it goes sideways, all over the place. And I've had pools in Solana in the past now. So this is like what actually happened in the past. It's not a guarantee for the future. But in the past, I had a Solana position that I just left alone for an entire year. I forgot about it. And sometimes I went out of range and fell back in range. Sometimes out of range, sometimes I just left it though. 112% for those 12 months. And if you looked at the actual price action on those 2 points in time from when I opened the pool to when I closed the position, they were almost exactly the same. It was something like 142 and like 147, somewhere around there. The point is, if I had just bought Solana and held for a year, I would have made like a couple $1,000. Instead, I opened the position, farmed for that entire year, and made much, much more than that. So I'm just going to mute these couple here. That's we're getting some feedback. Okay, so what I'm going to show you here is I've got a wallet ready to go, loaded up. with some Solana. I'm going to open a position of Solana and USDC. Okay. I'm going to check the chat first. So if your goal is to yield farm using LPs and you want to also realize bull market upside of SOL, for example, do you have a strategy for rebalancing the LP that helps you realize the upside? Um, yeah, William, your question, I understand what you're trying to ask, but the question is not a good question because it's not a strategy to realize the upside. If you sell the assets after they've gone up, you will realize the upside. It's a separate condition from farming to earn trading fees. Okay, so SOL USDC. Move our faces over here to the other side. There we go. All right, and this is going to say, hey, create a position. Great. I'm going to create a custom position. And I'm going to set my range. Now, I know ahead of time 2% on either side of current market value is way too tight. I'm going to make this a little bit wider. And I'm going to check out what 10% and 10% is. That's going to give me about an estimated 68%. Okay, well, let me pull that out a little wider. That looks good. Let me pull this out a little wider. That looks good. Well, that's a little bit too low. I'm gonna adjust my ranges. I want to get at least 50%. Okay, so this is estimating at 52%. Now, again, I know ahead of time that in all likelihood that percentage is going to go up because Solana is less total trade volume on average the last like month-ish than it has been in the past. And I'm looking at a much larger time horizon. So I'm okay taking the 52% because again, I don't know for sure, but in all probability, the highest likelihood is that this APR will go up over time, especially as we move through the calendar year 2026. Okay, so I've got my range set, and I'm scroll down here, and I'm going to turn on a little feature called auto swap. You don't need to worry about that right now. Basically, all that means is if I don't have enough USDC in my wallet, because I don't have much in here right now, if I don't have enough, it will swap a portion of the Solana for me in order to create a balanced pair. So I'm going to put in, I want to do, let's just say $30. Okay. So I've got $30 of USDC and it's going to put in to balance the pair, it's going to put $36.72 worth of Solana, which at current market rates is 0.257 and some other numbers. And then I am going to scroll down here. And the first one is step one trade. Because like I said, yeah, you'll be signing two transactions. I need to swap some SOL for some USDC in order to create this pair. It's going to bring up my Phantom wallet. I'm going to enter my password. And we're on the demo wallet. That's what I want. Confirm. Now click deposit. Okay, I will. See how quick this is? And that's why I said everybody wants to go to the tactics and the tools and the buttons clicking straight away. And I'm like, I could do that. I could say, hey, look at my screen, click, 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 click. I would do a bunch of stuff and you'd be like, okay, but why did you do that? Why did you do that? Why did you do that? That's why we start with strategies and then we move into tactics and we move into tools because the strategy informs how we do everything else. Okay, successfully deposited. Great. Now, if I want to observe this position that I have just opened, I go to portfolio and there it is. Here's my position range. Here's my range up top. And it's telling me the balance, the total balance, the value of the SOL and the USDC combined, the total balance is $66.64. And it gives me a breakdown of what that looks like right now. Now, here's the kicker though. This number will fluctuate. So it's not a like, maybe it's gonna, no, absolutely. This is something I can guarantee you. I guarantee you 100% that number will fluctuate. It will go up, it will go down, it will go up, it will go down, it will go sideways, it'll go up, it'll go down, all over the place. Okay. Chart does what chart does. That's just market doing market things. So that number will fluctuate. And what we experience often is when people are newer to the mastermind and they open their first position and they see this number fluctuate down a little bit, they go, I'm losing money. You're not losing money. The market fluctuated. That's all that happened. Now, this number, however, pending yield, this number will gradually only go up. So there, I just earned a fraction of a fraction of a fraction of a fraction of a penny while we were talking. So, because this is such a low number, the $66, I don't expect this to have a high dollar value, but we could come back in a week, a month, a year, and we could calculate what is the percentage gain. And again, just the percentage gain on the yield, just the percentage gain from the trading fees, and it will be between 50 and 100% in this example. Okay. So let's pause. Any questions, any thoughts on any of this what we've just covered? Because I try to fit it all into a 1 hour session. And I understand like that's a tall order, right? A while ago, I did a 7 day accelerator. We literally did 7 days in a row, 1 hour each day, and we still barely scratched the surface in terms of like the educational component. And that's why we run the mastermind. That's why we created that community for people because it's like, yeah, we know it's one thing to just get a bunch of education, but when you have someone, a mentor, a coach who's like guiding you through the process, it's now learn by doing. So when you jump in and actually click the buttons and do the thing, the learning, the rate at which you learn accelerates exponentially versus sitting there watching YouTube for 20 hours a week going like, okay, that's interesting. Like you learned, but did you learn? Like I would argue you got exposed to information. But if that information doesn't change your actions and that information doesn't help you get more of what you want in life, then you probably didn't learn anything of consequence. So that's why we've structured things to be learn by doing, but learn by doing under the guidance of someone who's actually been here before. Mark asks, so do you not rebalance the LPs in this process? Rebalancing is an option that you will have available to you. Well, really, it's available at any time. You can rebalance even when you're in range, but typically you would rebalance if you fall out of range and you remain out of range. So, what can often happen, and this happened with Solana a lot the past year and a half-ish, is that you go out of range, and then if you just do nothing and wait patiently, it comes back in range. And you're like, oh, well, good thing I didn't start clicking buttons because then that would have, I would not have made as much as if I had just waited for the thing to fall back into range. But knowing when to rebalance and how to rebalance, depending on market conditions, depending on asset selection, depending on target APRs, there's many variables, and that's why that's something that you would do in conjunction with a coach or a mentor. There's not like one overarching rebalance principle other than to say when you go out of range, the option is available to you, but you might not always want to immediately take that option depending on what's happening in the market at large. Good question, though. Who else? You can drop it in the chat, or if you're feeling brave, this would be a time when you can unmute yourself and talk live here. Now's the time.
Hey, Brandon. So, quick question, follow up on your answer that I didn't ask a good question. Do you recommend if you have a current portfolio and you want to yield farm, but you also want to try to take advantage of this next business cycle or bull run upside, that you split it and focus part of the portfolio on yield farming and then part you just hold in your long-term?
Yes, that's absolutely an option, and it's a hedged play. It's a very, in my opinion, a very wise and strategic play to do it that way. And you can also acknowledge that if I'm starting out in yield farming, I can take the yield, the trading fees that I've earned, and I can add that to my bag of unpaired assets. So no matter what percentage allocation that you start with, you'll have options to reallocate what that percentage distribution will be for your total portfolio.
Okay. And so in your mastermind, you have different strategies of how to split that up.
Correct,
And
exactly. Yeah, that's more of like a, hey, let's have a much larger one-on-one conversation about where your starting point is, where you want to go, what would be the most appropriate allocation for you personally. Again, it's back to the fitness metaphor. Like I would never prescribe one workout for 100 personal training clients. I'd be like, well, here's some general principles, but then we're going to apply them differently depending on each individual situation.
right, because I have a couple year horizon I want to hit. And then I'm hoping to learn enough about yield farming that I can then, once I hit that goal, become more conservative and just yield farm along.
Exactly. And there are ways to be ultra conservative on the yield farming front. So for example, we didn't cover this today because we're talking about, hey, I want to grow rapidly. But you can take, for example, two stable coins, USDT and USDC or USD1 and USDT. You can pair those and you can average like 9 or 10% a year. And you go, well, that's not a lot. But you're talking stable coins where there's no fluctuation in the base assets. So if your priority is protect my base capital and only like incrementally add to it over time, that's another option as well. So what that does is it gets you in that range of what they say is the average for the S&P 500, 8 to 12% a year. But what they don't tell you is like, well, yeah, but it's the stock market, and every so often, 2008 happens again, and you lose 80% of the value of your portfolio. So again, if preservation is the priority, that can be accomplished in DeFi. It would just be pair up some stable coins and get my 9 or 10% a year and call it good.
Thanks.
What else? Now's your chance. We're live. Ask your questions. So if anybody wants to carry on this conversation like in a one-on-one format, I intentionally opened up more slots on my personal calendar for Friday afternoon and Saturday morning, if anyone wants to have a little more in-depth conversation. So what that would look like is, hey, you'll fill out a very short application for the mastermind. It just gives us some really basic information about you and where you're at. And a lot of you have already filled out that application. So if you already filled it out, great. We have that on file. You don't need to fill it out again. And then we'll have a more in-depth conversation where it's like, hey, let's take these principles and discuss what that would look like for you to apply it given your life situation, your financial readiness, where you want to be in 8, 10, 12 years, whatever the case may be for your time horizon. And we'll just dig into it a little on a more personal level rather than in the group environment like this. So let me grab while we're talking about it. Okay, so this link, the one I just posted there in the Zoom chat, that is if you have not yet filled out an application with us. If you have already filled out an application, then I apologize as a wonky looking link, but that goes directly to the calendar booking page. Or if you've already filled out the application, then we're probably in conversation either via email or text or whatever. And you can just reach out to us directly. It might be me, it might be someone from the internal team, but someone will get back to you and we can arrange a time that works. Okay, Alex, how do you get 50 to 60% a month? Alex, if you want 50 to 60% a month with regularity, this is not for you. I filled out the application. I'm flying to Vietnam tomorrow. Okay, back in 2 weeks. Could I still schedule a one-on-one with you in a couple weeks? Yeah, just William, whenever you get back, just let me know. Just text or email or whatever, and then we'll put something on the calendar.
Okay, thanks.
Cool. All right. Well, let's do this. I'm gonna stop the recording, and then we're at the top of the hour. So if you got to bounce, it's all good. If you want to hang out for a little bit, I will also hang out for a little bit, extra questions and whatnot. But otherwise, thanks everyone for joining us, and we'll have the replay available at some point. We'll probably send it out if we don't get it sent out tomorrow. That's my goal is to get it sent out tomorrow, but if not, then we'll send it out early next week.